We'd like to start our next session. I'm Stockton Williams from the National Council of State Housing Agencies. It is always a privilege to be at an NHC event, and the Solutions Conference is probably my favorite. We've got a really interesting panel today and a terrific lineup, so I'm just going to jump right in with a quick overview of the topic and introductions of each panelist, and we'll begin. Many of our most relied upon federal housing programs have gone without significant updates in decades, creating an opportunity to improve housing services through modernization. What we're going to do on this panel is go through a number of federal policies and programs and talk about where there could be opportunities to modernize them. What does modernize mean? Well, we're going to actually start the discussion with that term. It means many things and different things depending on the program or policy. And we'll make sure to leave plenty of time for your questions and comments at the end of the session. But let me just quickly introduce this fantastic group. To my immediate left is Chris Cook, Chief Executive Officer of the National Affordable Housing Management Association. To Chris's left is Jonathan Reckford, CEO of Habitat for Humanity International. Next to Jonathan is Andrea Allen, Managing Director and Head of Affordable Housing on the real estate team at Pretium. And to her left, of course, is Mike Novogradac, CEO of Novogradac. What's terrific about this panel is they have expertise and have worked directly in really the entire range of policies and programs that you all work with. So we'll be able to cover a pretty wide landscape. And to start us off, I just want to come back to that key word in our panel's title, which is modernization, and ask each of our panelists, starting with you, Jonathan, what does modernization mean for you and for Habitat and the programs you're focusing on?
Thank you, and great to be with you all. And I think for us, for those of you who are not familiar, Habitat for Humanity, we advocate for the whole spectrum of affordable housing, but particularly focus on affordable home ownership. And therefore, our primary partnerships, which we value greatly, have been with HUD and with USDA for rural housing. And for us, modernization would really be making it faster and easier to partner in order to be able to build faster and build much more. Because I think there are examples where the limitations in the program, some of which are driven by Congress rather than by the authorities, actually make it so cumbersome that especially for some of our smaller affiliates, and we have over 1,000, many of whom are small rural affiliates, it is the cost of compliance and the challenges of navigating the process make it so difficult they opt out and don't participate, and or the amount of work it takes. And we could certainly go into examples, but it is, for us, it would be reducing some of the regulatory and compliance burdens. So really listening, particularly to smaller partners, and trying to understand from their perspective what it looks like to actually try to navigate the system. I think the second would be efficiency around staffing and technology. If you look at examples where, home would be a really good example. You can use home funds for home ownership, but at the jurisdictional level, at the county or city often, the home staff don't know how to do that. Therefore, they don't, not because they're not willing to, but they don't know how to. So you've got a capacity gap. And on the other side, on technology, USDA example, they only recently went to electronic applications from paper. The world has moved so fast, and I think the sort of technical capacity has not kept up in many of these programs.
Terrific. So several meetings, really all about lowering the cost to build and add to supply. Chris, how about for you? What does modernization mean?
Thank you, Stockton, and thank you, NHC, for this great conference, and it's great to be here with you all. So from the management perspective, and we often deal with where the rubber hits the road, the practical, I would say globally it would be streamlining regulation and making sure that you're regulating the right things within a federal agency, but with that, aligning the regulations across the programs. So NAMA members participate in all the federal rental assistance programs. So think about if you have a property that's with multi-layered financing, which almost every property does, it ends up there. So you have LIHTC, you have home, you might have rural. In some markets, you'll have HUD. And so our members have to have a spreadsheet with all the different requirements of every single financing source and be able to comply with all of them. And so how do you do that, especially when there's conflict, for example, the student rule. So generally you have to manage to the most difficult or the most extreme requirement. And so aligning those while we're streamlining would be fantastic. And then last but certainly not least is updating the processes and operations of the agencies themselves. For example, in a federal agency, do you really need 12 people in a linear process signing off on a grant? And what impact does that have on getting the grant out the door?
So modernization could make it less expensive to operate affordable housing, serve folks that we're all trying to serve.
Absolutely.
Mike, how about for you, modernization?
Yes, first of all, thanks to David and the NHC team. It's a pleasure to be able to join you here today. For me, modernization is trying to respond to the changing environment and taking into account the various lessons learned. And I think we at Novogradac are in a unique position, being practitioners, doing the audit and tax work, doing the projection work, doing the valuation work, and the rest, to try to identify some of the challenges that you would say to yourself, the rule ought to be different here. And then we've set up our various working groups to try to identify the areas where we think the various incentives that we work with can be made more efficient. So we do have a number of ideas on both the legislative front and on the regulatory front that we think can increase the efficiency. At the end of the day, it's about increasing the efficiency of the existing incentives as well as making them worthy of an expansion.
Super. And Andrea, your definition, your sense of what modernization means in your business.
So for those of you who are not familiar, Pretium, the company that I work for, is an investment management company that is really a residential ecosystem that has a broad perspective within the housing sector. We own and operate single-family and multifamily rental housing. We also lend to developers and to home builders. And then we also originate and service home mortgages. And so a very broad perspective. Since 2021, we've been building an affordable housing business, and that has been focused on the Housing Choice Voucher Program. Over just the last 2 years, we have more than doubled the number of single-family rental homes that are serving the Housing Choice Voucher Program and are currently supplying near to $1 billion of private housing to support that program. So what does modernization of the Housing Choice Voucher Program look like? We care deeply about the administrative requirements associated with that program. We want to be providing quality, safe housing. And so modernization is really about how those requirements are being met to enable the program to better meet its goals, to enable families to get housed faster, to bring more private housing to the table to support the program, to provide greater neighborhood choice, and then to keep families stably housed. The Housing Choice Voucher Program, like all of the programs we're talking about today, are public-private partnerships. We work with over 125 local public housing agencies across the country, and we have seen varying degrees of commercial execution and modernization in terms of the way that they run the program. To give you a clear example of this and some of the best practices that we've been sharing with HUD and other stakeholders, they can really make a difference in terms of the program's outcomes. A clear example of the administration is the fact that it takes much longer to get a family with a Housing Choice Voucher into housing than it does for a family that isn't using one. With public housing agencies that are using best practices, it can take up to 30 days longer. And with others, it can take well in excess of that. And that has real financial implications in terms of the vacancy. In HUD listening sessions last year, housing providers, cited shortening those move-in timelines as an opportunity for modernization in this program that can really enable it to get more families housed. So modernization of the Housing Choice Voucher Program is about improving outcomes and is focused on three major themes that I feel like all three other panelists have touched on. It's about technology, and it's about processes, and then it's also about using accurate data as it relates to running the program. So look forward to going into that deeper.
So thank you all for setting the table for the discussion. As a reminder to all of our attendees, if you have questions, you can get them to us through the app, and we'll get to those before we wrap up. But let's now go into some specific legislative proposals, existing program regulations, and really get into some more specifics about what modernization can mean and how it can impact affordable housing. So Mike, first to you, the Affordable Housing Credit Improvement Act, which I suspect everyone in the room is familiar with, a big opportunity to expand the housing credit program. Talk about that a little bit, if you would, in the context of this panel.
Yeah, so in the context of sort of modernization, the long-term tax credit hasn't really been modernized since 2008. So that's been a while since it's been modernized, and there's a number of ways to make the incentive more efficient and more effective at producing affordable housing, making it worthy of greater expansions. One of the modernizations that's both a modernization and an expansion is this reference to the 50% test. You've heard it already in the course of the day. What many may not know is the 50% test wasn't always the 50% test. It used to be that you had to finance 70% of a project's cost with private activity bonds in order to be automatically eligible for tax credits. Not too many of you were practicing it at the time, but that was back in '86 when the credit was created. It was a 70% financed by test. And then by 1988, Congress recognized that 70% was too high a number and 50% was the more appropriate number, and it was lowered to 50%. Well, now when you're looking at the housing that's being built with private activity bonds in connection with long-term tax credits, oftentimes they don't need the full 50% of the bonds. They can't even carry 50% of the bonds. They issue a portion of the bonds, and they do what's called bond burning. They issue 50% of the bonds, and then they pay off half when the project is stabilized. So from an efficiency perspective, it doesn't make sense issuing 50%, having a 50% test when the projects aren't going to carry that level of bonds. So the idea of lowering it to 25% is much more efficient on an individual project basis in many cases. And then obviously it also frees up more bonds to finance more housing, which makes it a production program as well. There are 23 other provisions in the Affordable Housing Credit Improvement Act. And I would be happy to go through each one of them, but that's probably not what you want to hear. But I will say there's a number of provisions in there, and some of these could actually be dealt with from a regulatory basis. We just haven't been able to get Treasury to change them. There are VAWA protections, Violence Against Women's Act protections. There's tenant recertification protections. There's rules about casualty losses, rules around relocation costs, and a number of other rules that would be modified through the statute. And these are possibilities of getting through regulations as well. Unfortunately, and or fortunately, depending on how you look at it, any tax bill the tax bill that goes through this year is likely going to go through budget reconciliation. It'll likely be partisan, and as a consequence, by going through budget reconciliation, provisions can only put in there if they have a revenue cost. So there are a number of the items that are in the Affordable Housing Credit Improvement Act that probably won't pass the parliamentarian review. So some of these won't be able to be enacted as part of budget reconciliation, but hopefully we can get it passed through some other bill. But there's a number of enhancements in the Affordable Housing Credit Improvement Act. I'd encourage everybody to take a look at it. And I'd also, if you have other ideas as to ways that you on the ground see the long-term tax credit could work more efficiently, I'd encourage you to send me an email, because we're always trying to come up with new ideas as to ways to make the credit more worthy of expansion.
You make a great point. When the housing credit has been modernized in the past, that's not only made it work better, it's also led to more political support, and that's always key. Chris, Andrea started talking a little bit about housing choice vouchers. I know you have a lot of thoughts on how those can be improved and modernized, both with regulatory administrative action and also potentially legislative reform. So tell us what you're thinking.
Sure. So I'll just share a couple observations that kind of make the case that change is needed. First, for low-income Americans in need, or essentially renters in need of assistance, only 1 in 4 is currently receiving it. In addition, homelessness is at the highest levels ever. And then meanwhile, more than 80% of HUD's budget is for rental assistance. So something's not working in that formula. So, you know, you kind of look at two broad approaches. One is funding, and the other is delivery of that funding. You know, from a funding perspective, and this was in the president's past proposed budget, was making HUD funding or rental assistance mandatory and increasing it. But what if we even went further and said every renter who needs assistance should get it? And maybe we could do some artificial intelligence modeling to see what could be the potential positive impacts on the federal budget otherwise. There was a great comment earlier today about not looking at housing just as a problem on its own, but looking at it as a potential solution to all the other problems affecting America. So what could be the positive impacts potentially on healthcare delivery, Medicare, Medicaid spending, if seniors can stay in their homes instead of going to assisted living? Education and educational outcomes, a lot of data out there on the positive impact of stable housing on education and outcomes in life. So really broadening the potential impact of funding. And then there are potential improvements in the delivery of funding. HUD just issued a request for information this summer on direct rental assistance. What if the public housing agencies provided the funding, their rental assistance directly to the resident instead of to the housing provider? Now, all of these things require great technology to make sure that everything is working well and that there's accountability, but we'll get into the technology question in a little bit. But there's lots of opportunity, I think, for brainstorming and solutions for some of the intractable issues we've been facing.
Thank you, Chris. Let's go to technology. Andrea, you mentioned it a little bit in your opening remarks. Could you say a little bit more about how it can be a tool, not only for your company, but also for some of the organizations that you work with, including public housing authorities?
Yeah, I would say that there's great opportunity as it relates to technology. We are seeing public housing authorities really deploy technology that can kind of speed some of the processes. An example of that is just a communications portal. There are, additional administrative requirements of the Housing Choice Voucher Program. You have to do the request for tenancy application. There are inspections to make sure that it is quality and safe housing. And then there's also the contract by which the rental assistance is paid. The reality is there's often a waiting period between when some of those administrative steps are completed, when everybody and when everybody involved is aware of their completion. And some of the public housing authorities are really using technology to change that. So instantaneously, you can know that the home has passed inspection and that family can move into the housing. There are also examples on a more basic level. The reality is the Housing Choice Voucher Program is administered locally by over 2,000 public housing agencies across the country. The vast majority of them are using direct deposit to make their housing assistance payments, but that means that some of them are still sending it by check. And so I would say technology has a wide range in terms of the opportunities for modernization. Another clear example of technology being able to provide modernization within the Housing Choice Voucher Program is on those home quality inspections. We saw during the pandemic the use of virtual inspections, which certainly saved. It was a matter of public safety and health and safety, but it also had the benefit of doing away with some of the scheduling issues. You have to get a housing inspector there, you have to get a service provider there to complete the inspection, and doing it virtually really provided some flexibility in making sure they were actually providing safe housing with getting those administrative steps completed more quickly. I would also say, I've worked with some of you here today, supporting technology companies that are looking at innovative solutions that they can offer, not only to make it easier for housing providers to, match up with Housing Choice Voucher families that are looking for housing, but also helping the public housing agencies be able to run more efficiently and be able to go through some of their administrative steps. An example of that is the income recertification. They have to income recertify the families on an annual basis, and there are some ways in which that can happen more quickly. And there's other pieces of the modernization of the Housing Choice Voucher Program that we could certainly touch on as well. The two other areas that I would mention. One is just process. And I think the key example there is just the focus on it in terms of getting things done quickly, really tracking our timelines. We as a housing provider, track our turnaround time on some of those administrative pieces. And when we mentioned, hey, we're tracking how long the request for tenancy application sits in our lap and how quickly we get it back to you. And their response was like, that's funny, you guys are tracking that. We're doing the same thing. And so together we can get people housed more quickly. And then the last piece of it I would touch on is using accurate market rent data. And the way that shows up in terms of the modernization of the Housing Choice Voucher Program is really in determining what is the market rent that's affordable using a Housing Choice Voucher. And we're seeing more and more public housing agencies use small area fair market rent that's set at the zip code level that can enable market rent to be affordable outside of lower opportunity neighborhoods. We measure the neighborhood characteristics where we're providing housing, and when we looked at the homes that we newly leased to Housing Choice Voucher families last year, we found that we were providing the choice to live in neighborhoods that were safer and that had lower poverty rates and access to better amenities such as schools. And that's relative to the Housing Choice Voucher Program more broadly. And then the second way in which that market rent or using accurate data shows up is really in the rent reasonableness. On an annual basis, you're looking at whether or not the rent that's being charged, importantly, that it is in line with market rent. And we're seeing public housing authorities really look to make sure that they are using up-to-date data and that they're using data that is truly comparable. And there are organizations and companies out there that are helping support those efforts. So overall, the modernization really kind of drives those outcomes.
Terrific. Jonathan, you talked about capacity for a minute in your opening remarks. With respect to smaller units of government, I suspect it's also a big issue for your delivery system and partners, especially in rural areas where Habitat does so much work. Could you reflect a little bit on the opportunities to improve programs so they can work better in rural communities?
Well, we've got, I think it's less visible, but there's a massive housing crisis. I'm preaching to the choir here, but both qualitative and quantitative in terms of the shortage of housing and the quality of the housing. And so the ability to fix it or improve, to me, so much is about time. And I think when we think about technologies, I think we think, oh, tech will fix it, but so much is actually the processes. And I think the giant savings would actually be in simplifying processes. There are a couple areas that would really help. One is getting rid of the doubling up. So often you've got local jurisdictions adding their own requirements on top of the federal requirements, and that creates sometimes an impossible compliance challenge. I think there are even simple examples of programs that were designed for a different era. So if you were designing solutions after 2008, you were worried about empty houses and a very different environment and lending. You fast forward today and we're looking at an environment where we've got a massive supply problem. So we are just consumed with how do we create more housing faster. One very trivial example, but there's a USDA requirement that you have to publish in the local newspaper a warning period. Well, you don't necessarily have local newspapers everywhere anymore, and they're not necessarily achieving the purpose. So it's a great example of a good intent, but the execution is not necessarily achieving what you would want. And I think the challenge, especially when you've got relatively small nonprofits or small builders, is how do you make it easy enough that they can actually be successful on a timeline that really works? I think the timeline issue is a gigantic issue as well, because you've got to move quickly on land, but you've got to wait forever to figure out if you can comply. And often it's not just one program. To your point, you're bundling a piece of this with a piece of that, to try to make the math work. There may be 3 or 4 different pieces you are trying to pull together. And therefore, anything we can do to speed up the timeline, simplify the process, and allow a little bit more flexibility for the variety of organizations that are trying to partner, I think could make it actually an enormous difference in terms of how fast we could go. The other, unfortunately, is capacity. So USDA actually reduced the amount of funding for housing in their programs. And I actually think if we could, it's both sides. If you could make it easier to use, we could show how much unmet demand there is, which would actually make the stronger case for restoring or expanding that funding.
Mike, one critical policy where a multi-year modernization effort looked like it had been achieved is now in uncertain territory. So could you catch us up and talk about the importance of the Community Reinvestment Act?
Yeah, so the Community Reinvestment Act drives a lot of the equity investment in the low-income housing tax credit and a new market tax credit, and to a lesser extent, some with respect to historics and marginally on the renewable side. And that's one of the reasons why you get premium pricing in a lot of low-income housing tax credit transactions, and you end up with this notion of CRA hot, CRA not spots and such in terms of equity pricing. And that's driven by getting Community Reinvestment Act credit. And I know everyone in this room knows this, but when you go on the Hill, you have to remind people that Community Reinvestment Act credit's not a tax credit. The Community Reinvestment Act is you're getting a positive assessment from your regulators, which is important, particularly more so going in with the new administration. I think bank ratings are going to be more significant to the banks themselves. But when I think about the Community Reinvestment Act, I feel like I'm getting whiplash or PTSD, I'm not sure what, because way back in 2020, Chairman Auditing or Comptroller Auditing of the OCC ended up passing through a set of regulations that would just affect those OCC-regulated banks. And it went through a whole process, and we were concerned about how that might affect investor interest. New administration, President Biden takes place, pulls those, so then we're back to the old ones. And now, in the course of the Biden presidency, the regulators, all three agencies got together, and on September 23rd of last year, they released a final rule, and it did away with the investment test of the old rule, of the legacy rule, and that's one of the drivers for investment by banks. It did do a lot better directionally than they came out with some proposed regs that were really concerning, and then the final regs looked like they may have addressed them sufficiently, but we kind of didn't know. And for now, we haven't been able to find out because they were scheduled to start taking effect on April 1st of this year. And on March 29th, there was an injunction. There was a lawsuit filed against them by a number of banking associations. So the regs, there was an injunction for them going into effect. And for every day that the injunction's in place, all the implementation dates get pushed forward day for day. That injunction's still in place. The oral arguments hearing is going to be February 3rd of 2025, and a number of briefings leading up to that. So as far as it looks now, those wouldn't start going into effect until no earlier than after the oral arguments in February of next year. But I think there's a lot of speculation that when Trump takes office, those regs will end up getting pulled. So it'll be, we had the auditing regs, then we didn't. We had sort of the Biden regs, and then potentially we didn't. And then we'll basically just be back to where we were before 2020 with the legacy rules being in effect. And then we'll see what happens going into the future. It'll certainly be nice when Community Reinvestment Act isn't something that who wins the presidency defines whether or not the regulations change or not.
Yeah, I would add to that because before joining Pretium, I spent over 20 years at Goldman Sachs and helped build its community development investing and lending business. And we, actively focused on CRA reform. And to Michael's point, like it was constantly changing. And we're trying to adjust our business and seeing how we might have to show up for the communities where we operated differently. And so I think one of the opportunities, hopefully, is to get to some amount of certainty so that we can, keep the CRA capital flowing into these, low and moderate communities who so desperately need it, and continuing to supply the affordable housing.
And some modernization is needed. When you think about internet banking, which wasn't the case, 20 years ago, so there's definitely modernization is needed. It just needs to be done in a way that can survive administrations of different parties.
Well, we said CRA, and that means we're now at the portion of the program where we're going into the alphabet soup of federal housing policy that we all know and love. And so, Chris, I'm going to let you start, and you can pick between HOTMA and Inspire, and you can talk about either or both, but as you do, just remind those in the audience what those clunky acronyms stand for.
Okay, sure. So HOTMA is the Housing Opportunity Through Modernization Act, passed in 2016, and keep that date in mind because we'll come back to it in a minute. And then Inspire is the National Standard for Inspection of Real Estate, which was created by REACT, the Real Estate Assessment Center, which is part of HUD, to ensure that rental properties that receive HUD funding, and it's used in other affordable programs too, is safe and quality. So we're talking about modernization. Here's two great big examples of modernization that's intended. It's kind of underway, and they've both stalled because of technology. So we were talking about technology. There is a theme here. So HOTMA passed and enacted in 2016, was intended to streamline for the management community and the programs as a whole are the income and asset determination for residents. It's supposed to streamline, make it efficient, make it easier to participate in the programs for both residents and owners and agents. And there was a lull in actually drafting the regulations, and then lo and behold, let's hurry up and get it out. And then we hit we don't have the technology at HUD to make it happen. So we're waiting for TRACS to be able to receive the new calculations, and TRACS is the tenant something. It's where HUD talks to the, it's a really old one, old acronym, but it's essentially HUD's aging, big old hulking, think about these great big hulking computer. It probably takes up half the HUD basement. And has those little cards you put in it, and it's, but it's the thing where you can receive your voucher and get payment, but it's not been updated, and each time we go to update it, another law is passed that would impact how TRACS works, whether it's VAWA or other things, and so we keep holding on what it needs to do. So HOTMA was supposed to go into effect January of 2024. There is the final rules out, and then it was January 2025. Now it's July of 2025. And meanwhile, the software specs, the companies that provide the software to the owners' agents that enable them to talk to TRACS, they have to know what the specs are for TRACS to be able to do all of that. And so we're kind of in this, we need this before we can do that. So technology is huge to modernization. Inspire, similarly, it got slowed down a little bit by the pandemic, but it was designed to make the inspection of properties more focused on the quality of the rental unit itself rather than the total property, so less emphasis on common grounds and things like that, but a definite emphasis on health and safety of the unit. And it's been rolled out. It was a great demonstration program. I think HUD did a great work in bringing in the regulated community to discuss it and be part of the demonstration program. But at the end of the day, the problem has been the technology in being able to see your scores, respond to your scores, tell HUD you've fixed the things. We actually had a member who, there's some standards where you have to respond and fix something in 24 to 72 hours, depending on the health and safety impact. You couldn't see what your scores were, so therefore you couldn't respond. And there was they received a notice of, we're going to take over your property or put you under a penalty because you didn't respond. It's like, I didn't know. And so those basic things where technology is the last 100 yards of making something work are so vital. So whenever we talk about modernization, whether it's a reg or a law, we have to look at, this is a great idea, but can we actually do it? What will it take so that we can?
Yeah, I think Chris really highlighted the challenges with the rollout of those modernizations. I mean, both of them focused on improving the inspection process and really focusing those inspections on health and safety issues. And it's a real opportunity to be able to meet the intended goals, but simplify it. You know, they allowed for, self-certification of certain fixes that are non-life-threatening. They allowed for less frequent inspections for housing that is consistently, passes as being safe and quality housing. And I think, the point that Chris made, that we've just got to be able to put the tools in place and the technology in place so that we can actually implement these modernizations that are, so keenly needed.
I'm getting ready to open it up to your comments and questions, and so there's still time to get them in through the app if you have them. But one last round from me, and Jonathan, we'll start with you. We've talked a lot about modernization in terms of simplifying and streamlining and doing various things in regulations and administrative processes that all sound positive. We know that the incoming administration is going to be very focused on deregulation. Are there things we would worry about if a deregulatory effort maybe goes too far in the wrong direction that would actually undermine efforts to modernization? And you can pick any particular program that you all work with or any place you want to go.
I actually see more benefits than risks. So I think to me, maybe the word I would add is flexibility. And what the most attractive part of some deregulation would be to make programs be more flexible for the very different contexts. So you take rural, you have rural areas that are incredibly high cost, and you have rural areas that are low cost. You have rural, and it's very hard when the rules are all the same. So for example, we would love to have more flexibility in places where labor is incredibly scarce, skilled labor, to do more modular building. And have the flexibility to do that, or in a different way to find, there's a small program called SHOP, Self-Help Home Ownership, that HUD administers, and they've got very strict guidelines, and you've got to have a project completed beginning to end within 24 months. Well, in some markets, that's great because they have systems and structures that are fast. There are other places where the environmental review could take 24 months, and so there's no way to get through, and so having the flexibility for context to make it work. And the other side would be flexibility in terms of local jurisdictions' ability to work with that program for the needs in their area. So I think I suspect I have more fear of the downside of deregulation than I do the downside of just cutting capacity at a time where the needs is so great.
I'm glad you mentioned the SHOP program. Mike, any policy or program you want to make sure we touch on before we open it up to questions?
There is, and many in the audience could probably guess what it is. It's opportunity zones. And I wonder how many here realize that over $100 billion has been invested in opportunity zones since they were enacted back in 2017. And it's only a few $1 billion in 10-year cost. And I feel like if I had come to a group and said, I've got this incentive, it's going to drive $100 billion to roughly 4,500 distressed census tracts that are low-income community census tracts, either 80% AMI or below, or a 20% poverty rate. And I'm going to get $100 billion invested in these. And oh, by the way, it turns out a lot of it's going to be residential rental housing. It seems to me, most people would say that seems like a pretty good deal. And studies show that the housing isn't driving up rents in these communities, as you wouldn't expect it would. It is driving up property values, but it's not driving up rents. It's obviously making more housing available, as well as funding a number of other activities. And I always feel a little defensive with opportunity zones because most people's impressions of opportunity zones are those anecdotes of something that they heard about that the New York Times reported on or something else that you might look at objectively and say, okay, that's not what I would have wanted to be done. So I do think that there can be guardrails and such that need to be put on it. I do expect that opportunity zones there'll be a major effort to renew them and to modernize opportunity zones as well. And I do think it's a great opportunity, kind of following up on what Matt Ryline from NEF was saying earlier, how we got to get more of these incentives to work together. Opportunity zones is a shallow subsidy. It's not going to make something that's uneconomic economic. And deep low-income housing and the rest that is uneconomic, so you need additional support. But opportunity zones can be part of that. And when I did testify at the Senate Finance Committee at the end of July, ranking member Mike Crapo from Idaho, who will be the chairman, come next year, the first question he asked me was, how can we have these various incentives work better together? So I do think there's a huge opportunity to look at something like opportunity zones and low-income tax credits, new markets, historics, and the rest, and find ways for them to work better together that could create a lot more equity out there for investment in serving distressed families and distressed communities.
Andrea, anything that we haven't touched on that you want to make sure you get a chance to address?
I would say, in terms of modernization, I think it really requires taking action and leading into execution. And we touched on some of these points. The need to incentivize innovation and provide the necessary tools. We talked about technology. The other thing that Jonathan's comments remind me of is flexibility. We need to have flexibility on the use of funding so that public housing agencies can be able to invest in the technology that's going to really modernize these programs.
Perfect, thank you. We've already got some excellent comments in here, and what I love about a number of them is they're actually aimed at solutions. So I'm going to start with some of those, and I'm going to pitch them to a particular panelist, but any should feel free to respond as well. So Chris, and maybe Andrea as well, this one looks right up your alley. What if tenants with housing choice vouchers could recertify every 2 years or even every 5 years? Has any research been done on the savings that would benefit from reducing that administrative burden?
So I think that there were ancient studies at HUD about slowing down the recertification process in essentially removing the disincentive to do better financially from the tenant so that they wouldn't have the immediate penalty of, my pay went up and so therefore my voucher is at risk. So I think there has been discussion and I believe there are ancient studies at HUD but it gets real complicated very quickly. As far as what's the magic point where you let folks build equity or build increased income, and then the need to move on out of affordable housing or away from rental assistance. And that's made even more challenging by what we'll call the missing middle. And I think there's a session on that, is that it's not so easy anymore because there isn't necessarily a place for somebody who's had a voucher to move up to what we would call workforce housing or some other kind of middle type housing before you get into conventional market rate housing. So the ladder of housing is missing some rungs. And so it makes it very difficult to say there's a clear linear path to moving to self-sufficiency. But overall, I think any kind of regulatory reduction and an approach that would allow landlords, PHAs, HUD, the whole community to work together to come up with a reasonable way to not penalize people for moving ahead, but also keep it a fair and open system.
You mentioned self-sufficiency. Jonathan, here's a question about whether there could be a modernization effort to make housing vouchers available for homeownership as well as rental housing.
It's interesting. It's actually already allowed, and the reason we don't tend to push for it is because there's such a dearth of supply that it's interesting if you take Chris's comments from before. First, if you had more full funding of vouchers, then you actually could steer a percentage of those towards homeownership, which would actually free up rental units and create opportunity. I think the second piece is it actually is one piece of those missing rungs on the ladder, which is if you had, in a sense, the opportunity for some percentage of people with vouchers to then move into starter homes, that then not only frees up rental units, but actually puts them on a more accelerated path. But it does mean we've got to build a lot more units in that middle and entry level, both for rental and home ownership.
Mike, here's one for you, and you'll have to unpack some of this technical jargon, but there's nobody better to do that and to put it in plain English than Mike Novogradac. So in the tax reform, is there an opportunity to get a basis boost for non-QCT 4% LIHTC deals? I swear somebody wrote that. So, but it's an important question.
Yes, it is. Yes, it is.
So
thank you very much. And it is. I mentioned there were 24, and you didn't let me go through all 24. So the 4% Credit Improvement Act does have in it a basis boost provision, and that's just a fancy way of saying a way to get 30% more tax credits. And this 30% more rule already applies for 9% credits. A state agency can say this project is eligible for 30% more credits. And since state agencies have an allocated amount of 9% credits, they're basically saying, I only have a certain pot, so we're going to put some more in this project, which means there's some other project I'm not going to be able to fund. On the private activity bond finance side, that's the other way you can get tax credits. Those tax credits are at the 4% rate. But the state can't designate that project as eligible for 30% more. There are ways they can qualify by being in a QCT or DDA, and I won't give you, I don't want to define what those are, but they're lower income areas. And there's provisions to modernize that in the Affordable Housing Credit Improvement Act. But there's one provision that would say, okay, state agency, if a development is getting 4% credits and needs more funding, you can deem that project eligible. So the credit percentage is essentially 5.2%, or you'll get 30% more credits on that development. That has a notable cost associated with it. And that's why when the discretion was given on the 9% credit, it wasn't given to private activity bonds. But that is, I would say that's number 3 in terms of what's being pushed for within the sort of broader affordable housing tax credit community. 1 and 2 are more 9% credits, both the 12.5% boost and a 50% increase, as well as lowering the 50% finance buy test that I talked about already. And number 3 is allowing this 30% boost. And that would really help rural areas where there's, as noted earlier, both the supply of housing but also quality of housing. So that is something that's being pushed for as part of a budget reconciliation bill if it goes down that path.
There was also a question about reconciliation and whether you could say a little bit more about the general rule for what would be eligible
Yes.
and not in this context.
Yes. So the budget reconciliation, and it's bipartisan in the sense that it's a U.S. Senate-driven concept, and in the U.S. Senate, if you pass a reconciliation bill, then let me say it this way, the reconciliation bill only takes a majority vote. So you can't filibuster a reconciliation bill. So when you have the Republicans controlling the Senate and the House, they basically say, we can do something without the Democrats having to support, so we can do what we want to do. And that's how if you go back to Bush 43, his big tax bill was passed that way. The 2017 tax bill, the Trump tax bill was passed that way. The Democrats passed the Inflation Reduction Act that way when they controlled the House, the Senate, and the presidency. So that's why everyone's talking about the reconciliation bill, and we know it's going to be hard if the Republicans only have a slim majority in the House, but that's the effort that's going to be underway. And the rules, then there are rules about this budget reconciliation, and it can run up the deficit over a 10-year period, but it has to be deficit neutral in the out years. And back in 2017, a number of the provisions that we're dealing with now that are expiring, the TCJA provisions, was because they ran up the deficit over a 10-year period, but the out year they couldn't keep them because it would have run up the deficit in the out years. However, they did make other changes that raised revenue in the out years so they can make the lowering of the corporate tax rate indefinite. So the corporate tax rate was 35 down to 21. That isn't expiring. So the general rule is you have to be revenue neutral in the out year, so whatever you do will generally expire over that 10-year period, but some things can be continued indefinitely. The other rule is it has to affect revenue. The provision that you have in there has to affect revenue, and the revenue effect can't be incidental to the policy purpose. That's why opportunity zones don't have any reporting requirements, because the original legislation included them, and the parliamentarian said, having to report on the results of this program doesn't have a revenue cost, so that was excised. And they go through what's called a bird bath. The Democratic Party, when they were trying to do budget reconciliation, they tried to put in raising the minimum wage, which would have a revenue effect, but the parliamentarian ruled that budget effect was incidental to the policy. So everything that we're thinking about as part of reconciliation, we know will likely expire sometime over that 10-year period. And we also know if it has a policy effect that it has a revenue cost that's incidental to the policy effect, it won't be able to be included. How'd I do?
That was amazing. Thank you, Mike. Andrea, a question for you, if you'd like to take it, about public housing. Moving to work designation allows PHAs to allow for biennial recertifications, but the increase in interim recertifications has actually slowed the process down and does not show cost savings. Any reaction, and really to any of you who may have perspective on this issue at the public housing level?
Yeah, others may be able to speak to the cost, but certainly when we're talking about flexibility in terms of the use of funding and the ability to test innovations, we've certainly seen that show up in public housing agencies that have a moving to work designation, and others that are participating in mobility programs. It allows them to be able to use their funding in different ways and be able to test innovations to see whether or not it works in their local community, such that HUD can then look at it to say, is this type of flexibility or program something that we could deploy more broadly to get more families housed?
There are a couple general questions in here about the home program, which is another one where there have been efforts to modernize and improve regulations that have made some progress. Does anybody here, home kind of touches everything. We don't necessarily have a home guru on the panel. Anyone want to talk about home modernization? If not, we can circle back to our questioner. Chris?
So I'll just say that home is vital for affordable housing development, which is sometimes one of the key pieces of funding that makes the deal work. There was a proposed rule earlier this year on improvements to home, some of which were good, some of which were questionable. But in all likelihood, that proposed rule, because you have a new administration coming in, will go back to the starting gate. I think right now we'll probably just wait and see what the next iteration might be.
I totally agree. I think we were enthusiastic that the effort was happening, but now great uncertainty as to whether it's going to have impact.
And I just would make the overall observation, which I'm sure virtually all of you probably are thinking about already with respect to the home program. When you think about the HUD budget next year and the challenges of the HUD budget with the incoming administration, and then you think about the HUD budget is made up so much by vouchers, project-based and tenant-based, that a lot of the other kind of grant programs are going to feel extreme pressure. And I myself am pretty nervous about home funding, CDBG funding, and another that more lump sum. Just when you think about it politically, the damage is someone in the future who hasn't necessarily been identified yet, whereas the vouchers are individual people that, for the most part, that you can identify. So I feel like politically that ends up being an easier place if you're looking to cut. So I think there's going to be a lot of battles ahead on that front.
I totally agree with Michael, and because we saw it zeroed out in previous years, although Congress did always stand back up for it. But I think it'll be incumbent upon all of us to explain the vital role that those HUD home dollars play in the development of affordable multifamily housing, which is my perspective, and that there's the acknowledgement in both parties that and constituents across the country that the need for affordable housing is any kind of housing is paramount right now, and so there should be no cutting of funds that enable development, and so that'll be incumbent upon us to make sure that that message is heard and understood.
I certainly agree. It's probably the most important program for our affiliates across the country overall. Though we get a very small slice, it is. I would say, just personal bias for this room certainly as they look at CDBG, protecting the housing funding out of CDBG, out of community development block grants, which is a relatively small piece, but I do think the message needs to be all about if you want to create more supply, those are the dollars they're going to have the most impact on supply, along with tax credits.
There's also, of course, a CDBG disaster recovery program that comes in after terrible natural events. There's flood insurance. There's a number of federal policies that are all sorely in need of rationalization and modernization related to disaster recovery. Not sure anyone on the panel wants to comment on any of those or any particular part of that. Is that something that I think we generally agree has been difficult for Congresses to deal with, but it's not as if the underlying issues are going to go away.
My one-word answer is yes.
Yes. Yes, reforms are sorely needed.
To all the above, yes.
There was a whole panel on insurance, but that's becoming a massive issue for us nationally, but particularly in Gulf states and the states that have had heavy flooding.
And I didn't get a chance to share the question for the insurance panel, but there is an aspect of the insurance problem beyond climate control, climate change, and that is that there are some carriers who, once they find out that your portfolio is affordable, do not want to provide insurance. So not only is there the climate change and the awful impact that's happening on properties across the country, but also the AI that goes into criminal scoring and things like that that make affordable properties not seen as properties that they want to insure.
On the subject of simple topics, how about GSE reform regarding Fannie Mae, Freddie Mac, and the federal home loan banks? Anyone want to weigh in with thoughts on that and the likelihood or not, and what modernization might mean in that scenario?
Yeah, I don't have any thoughts that Senator Warner didn't have a much closer insight to, and I just don't know with. And this is one where, in a year or 2 or 3 years from now, you can come up to me and say, Mike, remember when you said, I just feel like with everything going on, the GSEs are essentially in this regulated stance today. And, with everything that has to happen, where will this fall on the list? And it seems like it's a big challenge to try to address. And I just don't know if something will happen anytime soon. And it's just something that, from us at Novogradac, it's like, we'll wait and watch and read a lot of the analysis as to the different ways it could happen. And if something more sort of serious proposal starts getting discussed, then we'll get more engaged in it.
I would add to that I agree. I think the GSEs today are making money and they're functioning and showing up. And we talked about the fact that housing is so critical, and they're part of financing that housing supply. And so it feels like GSE, changes are something that'll come lower on the priority list and therefore likely come later.
Yeah, not much to add. I would say, one of the areas we're trying to explore, certainly with both Fannie and Freddie, is how to make it easier for them to work with small lenders. We are a small lender in the scheme of things because it's inherently less efficient to lend to, what are viewed as higher risk, even though we have very low foreclosure rates. But thinking about some of the things that were designed in the mortgage reforms, which is bigger than GSE, were designed really for large banks to cure the sins leading to the 2008 crash, but have made it much more expensive. And that's just more cost that's laid on at a time where affordability is already a challenge. So there may be some opportunities there as well.
Chris, last word.
Yeah, my last comment would be we'd be concerned about the affordability goals being reduced.
Affordable housing goals and the duty to serve,
And the
both
duty to serve,
critically
right.
important.
Yep.
Agreed.
Yeah.
Yep.
Well, we covered a vast amount of material. I hope you'll join me in thanking this terrific panel. And we now have a 16-minute break. So see you back here for the next session.
Thank you, everyone. As mentioned, we're now going to have a 16-minute break. Thank you. You gave everyone a minute back. Our final session of the day, the Missing Middle, Strategies for Expanding Housing Options, will take place here in the ballroom at 3:45 p.m. We look forward to seeing you back.